So we're back here again, Friday the 20th of May, and we end the day just under 13,000 crowns. For the week, we take a big blow, 53,000 Swedish crowns, but for the year, we're still up 426,616 crowns. So at the exchange rates, it is around 40,500 euros for the year, or roughly 42,000 US dollars. Sliding over to the percentage return, and year to date we're up 24.85%, coming down from a high of 32% we reached about a couple of weeks ago. But for the week we're down 2.5%. We compare that to the Standard & Poor's 500s, we see we're tracking with it. The S&P is down 2.78% this week. Year to date, it's getting crushed. It's down negative 18.66%. It managed to rally on Friday after hitting the magical bear market number, which is 20%. It hit the negative 20% for the year number around midday on Friday. But the markets then subsequently went on to rally and finished the day barely in the green. And so if we work our way through the different time frames, through the monthly, 3-month, and the trailing year, we see that we're up quite significantly against the broad markets still. Of course, the big move down happened on Wednesday when the S&P 500 and the broad markets in general just went down 4% for the day. So this was kicked off by the retail giants such as Target and Walmart releasing less than expected earnings numbers on their reports. And these companies are a good gauge for the sentiment of the US consumer. And so if the consumer decides to tighten its belt in regards to spending, that's going to take an immediate effect on the markets. And so with all the uncertainty this year, we see the markets sell down to negative 20%. But if we expand the horizon to a longer time horizon, we see that the S&P generally is trending up. But every now and again, the market must undergo a downturn, and this is healthy and should be expected. So bear markets are defined as sustained periods of downward trending prices, often a 20% decline from all-time highs. With this, generally a economic recession and high unemployment go hand in hand with the bear market. But despair not, because these depressed prices are often great opportunities for buying and buying aggressively. So stretching back to 2000, in the 22 years, there's been 3 opportunities where we've gone into bear market territory. The dot-com crash from 2000 to 2002, the Great Recession, the global financial crisis in 2007 to 2009, and of course the 2020 COVID pandemic. So given the power of hindsight, we know that it is during these periods of uncertainty that is the best time to expose yourselves to the equity markets. In fact, had you been totally oblivious to what was going on and someone had said to you, point out in this graph where you would like to have invested quite heavily, you probably would have chosen this period here. And of course that period there coincided with the dot-com bubble. This happened at the turn of the century, and it took 13 years before the stock markets reclaimed new highs again. This second trough, this second period, is the great financial crisis from 07 to 09. And during this period, the markets fell in excess of 50%. And again, had you been picking up shares during this period, although it was uncertain and painful at the time, it would have put you in good stead. And the third time that the market dropped 20% or more was the recent corona pandemic in 2020. Of course, it's a difficult thing to do the opposite, be contrarian, and to buy when everyone else is panicking. Hindsight shows that if you're prepared to do the opposite of what everyone else is doing, then these times of duress and distress offer the best times to get into the markets. In fact, had you just bought the dip during these periods, then over the long run, it would have put you in good stead. And this is the main reason why it's important to have a long time horizon when you're investing. With a long time horizon, you would have gotten away even if you had invested at the top of the dot-com crash. Of course, you would have had to have the stomach to ride it through, but had you bought at the top before the crash, before the dot-com crash, you would be up 166% today. Similarly, had you bought at the top before the great financial crisis, you'd be up the same amount. And again, had you got into the markets right before the corona crash, you'd still be up from your initial investment today. One of my biggest holdings is in Altria Group, and it makes up about 12% of my portfolio. We have a look at its performance this year, and we see it's returned 84,000 Swedish crowns. And of that amount, about 15,000 crowns has been through dividends. The last week you see that it's taken a big hit down, about 4%, and it's even worse if you look at the monthly time frame, and we see it's down nearly 10%. But let's stretch it out over a longer time frame and put it under the same microscope. So had you picked up Altria Group before the dot-com crash, before the bubble burst, and we'll say we'll start from 1998, 1999, because the prices were a lot higher than the subsequent 2000 price of Altria. The price in 2000 when the bubble burst was actually lower than the price before it. So we'll start from before the 2000 crash. So despite the wars, despite the uncertainties that's plagued between then and now, you would have been up over 380% on your investment. And of course, alongside the price appreciation, you also would have got paid dividends by Altria during that time. This chart only goes back to 2002, but even then, from 2002, we see that the dividend Altria paid at the time was 18 cents per share. And of course, subsequently, Altria has increased its dividend to its shareholders from that initial 18 cents per share to what it pays today at $3.60 per share. And so running those numbers on a return on investment calculator, we can figure out how much those dividends has increased from that time period. So we'll punch in the initial 18 cents per share to what the dividend pays now at $3.60 per share and go ahead and calculate that. And we see that the dividend increased by 19,000%. And in fact, annualized, the dividend increased per year by over 16%. And so that's important because one of the things that we try to do as investors is to beat the rate of inflation. And that's the erosion of our purchasing power of our money. And we see from the same time period, from 2002 to today, the rate of inflation in the US is around 60.71%. And so because I reside in Sweden, what's important to me is the rate of inflation in Sweden. And during the same time period, the rate of inflation in Sweden is a little bit lower than the US, but it's still 30%. And so if the rate of inflation in this case in Sweden is 30%, then we want to counter that as an investor. And investing in Altria, which has increased its dividend by 1,900%, it's gone a long way, definitely gone a long way to do that job. And because I'm a foreign investor using a Swedish broker to invest in the US equity markets, the currency difference alone beats inflation. This simply means that the US dollar has risen since 2002, has risen against the Swedish crown by 35%. Because I'm buying US assets, I'm getting paid my dividends in US dollars, which has to be converted back into my local currency, which is the Swedish krona. And this is why personally I'm getting aggressive, buying aggressively during this downturn, because I believe that the odds are stacked for me. This is the fourth opportunity in over 2 decades that we've had that the markets have dropped below 20%. And I don't see it as a reason to be scared or running away from the markets. I think the opposite should be done, and we should be embracing this opportunity. So that's why I'll be buying aggressively with these attractive prices. So that'll do, I think, for this week. I think it's time to go upstairs and have a few beers by the pool.